My name is Ndlovu. I'm a financial sector specialist at the World Bank. It is my singular honor today to welcome you all to our third webinar on this knowledge exchange program on strengthening financial resilience in the agriculture sector. This session is focused on lessons learned and the impact of Meso-Level index-based insurance and credit solutions from experience across the globe. Just a reminder that this is part 2 of a very successful webinar series that the Crisis and Disaster Risk Finance team of the World Bank launched back in 2021. This edition is really focused on lessons learned and what evidence we find on the ground from talking to practitioners, talking to regulators, talking to development practitioners on the application of these solutions. So very quick recap of the structure of the webinars. If you move to the next slide, please, Atsu. It's a total of 4 webinars that we're looking at in the session. Each session is 90 minutes long and it's accompanied by a fact sheet. So please watch out for the fact sheet that we will circulate after the webinar. You can also find fact sheets of the other 2 webinars on the website. Completion of all of the fact sheets leads to a certificate of completion from the World Bank. Each session, we host different guest speakers from academia, the private sector, the development sector as well. And in this current session, I am very, very excited to have a very high-level panel of speakers to share with us their experience on Meso-Level solutions. Next slide, please. And to give you a reflection of how far we've come or where we are at now, like I said, this is webinar 3. The first session looked at index-based livestock insurance, so very strongly focused on micro solutions. The second session looked at climate-responsive financial products and solutions across the globe. So there was quite a mix of micro and micro. Now the session is looking at Meso specifically. Our last session, which please look out for sometime in October, will be focused on technology and their implications for agricultural, climate finance, so both insurance and lending solutions. So very quickly, who can we expect to speak to us today? Our first speaker will be Dr. Jerry Skies. He is regarded as one of the world's leading experts on parametric solutions. His career in public policy spans 50 years, and like the mosaic, he also has a distinguished private sector record, founding several entrepreneurial ventures, including non-profit, not-for-profit, and profit companies. And of relevance today is Global Parametrics, which he founded and now manages over 60 million in capital, actively supporting solutions to climate and disaster risk in low and middle income countries. Our second speaker for today is Wendy Smith. So Wendy is the Impact and ESG Manager at Global Parametrics. She plays a major role in implementing Global Parametrics impact mandate to establish sustainable parametric disaster risk finance programs globally. She also specifically manages their technical assistance facility of over 3 million euro to fund projects that are being designed and innovating to catalyze risk finance and risk transfer across the world. Our third speaker is Chuck Olson. He is the managing partner at Enabling Capital. He is one of the founding partners, actually, and he's jointly responsible for managing over 600 million of assets under management. His experience or career in the financial sector spans over 25 years. Most of this has been in emerging and frontier markets, including back in 1992 as a rural finance expert with Peace Corps. He has experience with the World Council of Credit Unions across Latin America, Eastern Europe, Asia, and Africa. And just before setting or co-founding Enabling Capital, he was responsible for Blue Orchard's turnaround strategy and oversaw more than 2.6 billion of assets in their investment portfolio. So I'm very excited today to be joined by a sterling panel of speakers. Before I hand it over to them, I will just quickly frame the discussion on what we're talking about, or what we're referring to by Meso-Level, because as one participants raised the question in the registration, what exactly is there consensus on the definition of Meso-Level? And the answer is not exactly, but for the purpose of this session today, next slide, please, Atu. For the purpose of this session today,
sorry, Q, sorry to interrupt, but your voice is a bit choppy. I think it's something to do with your headphones. Maybe if you can try, it's not very clear.
Okay. Is it any better now?
No, it's still a bit choppy.
Okay. I can maybe turn off my headphones and go without it.
We can't hear you.
Is this better? So now?
Yes, absolutely. Thank you so much.
Okay. Thank you. Thank you. So I will just quickly frame the discussion by defining what we mean. So index-based solutions have flexibility and can be applied at various levels, including macro, meso, and micro. For the purpose of this session, we are focusing on meso. And by this, we're referring to solutions where the policyholder is typically a financial institution, so banks, cooperatives, or microfinance institutions, or agricultural enterprises. The objectives for using these solutions include protecting their loan portfolios against wide-scale defaults that are as a result of climate shocks and other disasters. They're hoping to ensure business continuity, to provide recovery lending to their borrowers. Also, we're seeing them use increasingly this solution to improve overall risk management. That's predominantly on the side of financial institutions. When it comes to agriculture enterprises, what we're seeing is use of the solutions predominantly to protect their business operations against any shortfalls in yields. And in some cases, there's an element of credit risk management where contract farming schemes use these solutions to protect themselves and farmers when their farmers are unable to have been affected by shocks. And how these solutions work as seen on the right panel. In the case of Meso, this involves the financial institution or the agricultural enterprise paying a premium to the insurer and receiving the payout. In the case of financial institutions, we're defining this as solutions whereby the financial institution uses that payout to ensure business continuity, to provide recovery lending, etc. In the case of agricultural enterprises, we do see some experience of use of part of the payout to the farmer indirectly through the intermediary. In some cases, we see part of the premium for paying for the solution coming from the farmer or being loaded onto the services that are being provided to the farmer. So this is what we're referring to today in our discussion on Meso-Level solutions. Next slide, please. And why might micro solutions, Meso solutions be better than micro, or how do they compare? What we're seeing is that, of course, with the micro level, it's clear that the farmer is getting the payment, so it is direct. Whereas in Meso solutions, in some cases, the farmer may not get a payout from the insurer, or it may get, or it may be indirect. There is on both sides questions of demand. In the case of financial sophistication, we see that in some cases, Meso-Level solutions may be targeting buyers that are more financially savvy. So questions of understanding financial capability are better addressed. we see that meso-level solutions have the potential to scale a lot more than micro, which are difficult to scale because of the cost of that last mile distribution, reaching small holder farmers that are in most cases geographically dispersed over large areas is very costly, and therefore leads to the next point on these micro level solutions tend to be relatively more expensive. However, with meso, because of the potential to pool risk, there is potential to have for solutions to be more cost effective. In terms of basis risk, we find that although it is a bigger issue in micro, it is less likely and problematic at the meso level. Business continuity continues to be an issue for smallholder farmers, but the rationale is stronger for meso. The business case with micro sometimes is harder to prove, especially depending on the segment of farmers that one is targeting through that program. In terms of subsidies, which we have seen as a big factor in enabling micro solutions, they tend to be very difficult to sustain in the long run, whereas with some of the meso-level solutions that you'll hear about today, subsidies may not be needed, or if they are needed at the beginning, may be easier to phase out. So I will not take any more time. We have one slide just showcasing some of the emerging evidence on how these solutions are enabling lending to the agricultural sector. You can find out more on this from the fact sheet that we will circulate shortly after this webinar. But I will not take more time. Invite Jerry Skis, please. Thank you.
Thank you, Q, for that background. I'm very happy to be here. I started working with the World Bank in 1996 on these issues, so I'm kind of the grandfather in some ways of these ideas. We did a lot of work early on at the micro level. I was involved with the index-based livestock insurance in Mongolia, which was invaluable for me and hopefully for Mongolia as well in terms of learning. So if we could go to the next slide, I'm just want to say that in my experience, I moved from the micro level thinking to the meso level. We've already got some context here. The insurance is being purchased by a risk aggregator. The problem when you're talking about a smallholder farmer in a small geography is there's just a lot of volatility in the risk, and it's really difficult to actually get a product that's suited for that smallholder farmer. If you aggregate across farmers like a risk aggregator does here, you can mitigate some of that basis risk, as Q pointed out. So what we're talking about is selling these types of services to the input suppliers. This can be agri-input suppliers that are selling seed, fertilizer, feed for animals. Could be the financial institutions as well, obviously, and we'll hear more about that here. Then you can do it through the output purchasers as well, and I'll give a couple of cases of that. Of course, we've all seen some very good examples of selling these products to the collective group of farmers, cooperatives, and Wendy will speak to that in a bit. And then we've got NGOs that work with farmers as well. So there's a lot of context here in terms of the entry point of what we call meso-level parametric insurance. If we could move to the next slide, what we're really getting focused on here is the problem. The problem is, again, that you have this extreme event, be it a drought, inundation that causes muddy conditions in the fields. Even we're working toward solutions where farmers who actually place their commodities on the ground after harvest, lots of people forget this, you get a yield, but if you store it on the ground to try to condition it and it rains, you've got a lot of spoilage as well. So there's a lot of ways to extend the thinking here, but the problem is that when you have that big, widespread weather risk that's being more frequent, more severe because of climate change, you've got a problem also for those firms in the value chain that are there to keep those farmers in business. So I want to come back to that point over and over again. We can think of ways where you have the risk aggregator that passes that benefit directly to farmers, or you can think about the bottom section here where the protection is really meant for the business continuity of the firms that are serving smallholder farmers, which I think is pretty fundamental thought process here. You can see a sprinkling of different projects and things that we've been looking at over the years. My first entry was really working with a firm in the United States for cotton processors in Texas to protect their revenue. So that was an entry point for me to start thinking about, oh, the insurance industry is actually interested in providing services to the firms that are in the value chain for farmers. I'm sure there are cases that go back before 2001 of this type of thing. But in this profile, you've got quite a few different examples. I'll give you some more detail on the value chain story in a minute with Vision Fund International in particular. And then Chuck will come back around with Enabling Capital, who we've worked with as well. If we could go to the next slide. All right, so what's now interesting, DRF is disaster risk financing solutions. And when you think through parametrics with a risk aggregator, you can start to frame it so that you're using the parametrics as you should to help people realize, oh, something's starting to happen. And maybe internally with this firm, we should use our reserves to try to build up the resiliency for what's going to happen here. So that's the self-retention part of risk management. And then you have the opportunity with some providers like Chuck Olson to get contingent credit. And then finally, the risk transfer. So all three of these can be triggered by a parametric measure of an extreme event. And in many cases, for example, in drought, we know that by the time the crop is halfway through the season, you know if you're going to have a crop failure. So you can build in even more and faster ways to do these types of programs to shore up and give the business continuity. So you've got that fast payment, you've got the balance sheet protection. You obviously are coming back to the principles of index insurance. There's no loss assessment cost, and you have limits on the moral hazard and adverse selection because it's an independent measure. Okay, if we go to the next slide. Business interruption is a big part of the story. And I think sometimes we forget that part of parametric offerings. We're always thinking about, oh, we actually made a payment in the moment and people have cash, but what do they do with that cash? And what do these firms do? And how does it help them with the business interruption, the economic disruption, the human potential? You know, a classic insurance policy is usually going to be based on an asset. And what I'm trying to get you to think through here is parametrics has potential to cover a lot more of the business interruption. You know, there's a lot of talk about loss and damage. Loss and damage has to include business interruption because when you're talking about smallholder farmers in particular, they don't have many assets. So for them, it's really about the business interruption and the firms that serve them, the business interruption. So that's a big part of where I'm going to drive some of this. I should remind you, I am an economist. I'm an agricultural economist. So you're going to hear a lot of economic thinking about this. If we can go to the next slide. All right, this is the most fundamental thing. Access to and cost of capital because of extreme events, these extreme weather events, seismic events. If you're in an area that's prone to these disasters, you're going to be facing restrictions on business and you're going to be facing a higher cost of capital. There's quite a bit of work that's been done in this direction. We're pretty conservative numbers here. You think about 100 basis points more for cost of capital because of these events, and that's in looking back. We did this work in northern Peru. We estimated it was 200 basis points. because of the recurrence of the extreme El Nino in the northern part of Peru. So these are estimates that are used looking in the past. We all hear these things from the UN WMO. Extreme weather disaster has increased fivefold in the last 50 years. So what's going to happen looking into the future with this cost of capital? These indirect losses are mostly pushed to the poor and vulnerable as well, because they have limited access and they have those limited assets. So those are fundamental things that I want to start your thought process here. If we can go to the next slide, we start to realize that in the story of the Meso, the fundamental principle here is business continuity. Because if you have these firms that get the shock, like this depiction of a financial institution, before and after the extreme event, you're eroding the balance sheet. And in that story, what happens is the firms, the financial institutions, have to restrict their business for smallholder farmers. And again, what we're really talking about here is using these products to open up that access and to lower the cost of capital. And this is a very dynamic economic story as you put it into time and think beyond just that first instance after the extreme event. So if we go to the next slide, I'm trying to get your mind in the position here. This is something fundamental because you've got a balance sheet that is stronger before the disaster. During the recovery period, you see the balance sheet is weaker. There's a lot of economic literature. It goes back into the mid-90s. You reduce the loan origination. As the current loans mature, the asset base fails. You've got this main cost of undercapitalization, and you're foregoing that profitability of lending into the future. Look, this is old stuff. This is almost 20 years ago. So the idea of providing the liquidity and capital is to avoid that capital crunch, to allow the bank to continue their practices, and to allow the bank to operate much better at a capital adequacy ratio so that they can leverage more as well. Now, what we're really talking about in the lower quadrant here is if you're protecting the capital adequacy, you can make this much more affordable for the risk aggregator, because if you think about these products, they're quite expensive. And you know, farmers, when we build the programs for smallholder farmers, we always run into this challenge. Oh wow, look, this is going to cost 10% rate online. Well, in the instance of protecting your balance sheet, maybe you only need to protect that small portion of the capital adequacy. And as the math shows here, you can get down to 50 basis points of the portfolio. That's a thought process that helps us think about how to present these products. If we could go to the next slide. This is really important, and I hope you'll walk away, if you don't get anything else from what I'm discussing today, I hope this image will be in your mind. Because what we learned is that these extreme disasters have a long footprint. It's not just the first year, it's the second year, and even into the third year. And the more extreme, the more problematic it is for the firms that actually provide the services to smallholder farmers. So the idea of the growth and these hidden costs, we're just not getting that story out strong enough. So keep this image in your mind. Let's move to the next slide and let's start to bring some of this into a bit more focus. So some years ago, Vision Fund came to me, and you'll see that Enabling Capital produced this slide. My friend chuckles. And so some years ago, Vision Fund came to me, and while we were actually trying to start Global Parametrics, and they were doing recovery lending. And I thought that was really a strong program, because as you know, most financial institutions reduce their lending in the moment after the disaster. So with Vision Fund, they had this vision of actually having recovery lending to give new loans, to give grace periods, to restructure loans, to support the vertical chains that supported their clients. And of course, the whole idea there is if you can do this properly, you still have growth, you mitigate the non-performing loans, you give stability to the balance sheet, and what Vision Fund learned is they were getting other clients because they also had client loyalty and they were offering services that others weren't. If we go to the next slide, you move forward from the early thinking, and we actually worked with Vision Fund. Now we've done transactions with them. I think it's now 6 years. And the idea here is that Vision Fund with a single transaction is protecting microfinance institutions all over the world. And we're providing the risk transfer, global parametrics. They're doing the recovery lending because, of course, the financial institution in each of those countries knows much more about how they're going to use these funds. And we had Insurance Resilience Investment Fund that was providing contingent credit. We've actually seen this work. We've seen payments. We've seen contingent credit. We've seen risk transfer payments. If you go to the next slide, I'll give you more perspective on how this program has grown. We're now protecting 27 countries in a single contract. And what we did was really important because we pooled across those 27 and we modeled out what the probable maximum loss is. They're getting about 13 million of protection today. And they only have to purchase cover of 2.5 million. So if you multiply a rate on line even higher for 2.5 versus what you would do if you had single policies for every one of these countries, you can see that you get significant cost savings. It's about a third the cost. So again, you're using the same event-based structure to trigger contingent capital, contingent credit, contingent capital. And as we're going to emphasize in a minute, this can all be done in a single debt instrument. If we move to the next slide, I guess you can hear me in my plea. We need to improve our messaging. So many times people look at Meso products and they say, well, if it doesn't directly transfer the payment to the farmer, then it's not really viewed as favorably. That's important. I'm not going to minimize the importance. But that reference point misses the whole dynamic of what I've just presented to you. And the idea that even the prospect of an extreme event is restricting access and increasing the cost of services to smallholder farmers. So for me, there's something much bigger that we can do if we can protect the Meso-Level value chain that's working with these small farmers. As you can see, emphasizing again, the unprotected firm will offer far more services. Sorry, that should be the protected firm would offer far more services to farmers who are, no, sorry, that is right, would be offering the services to the less risky farmers and not to the ones that are in the more risky regions. And by the same token, the cost of capital is going to be different. Again, I've repeated the idea that we can take the same logic to an input supplier, an output purchaser that's working, and we can use the economics on the lower right-hand side to present the case. So if we go to the next slide, our community needs better data. This is theory in some ways. We've seen cases where it's real, but we need better data. And it's hard to get the better data because we're talking about infrequent occurrences. Therefore, you know, how you actually do monitoring and evaluation on the backside of this is not simple if you're talking about something that occurs only once out of 50 years. We need to then think about how we do stress testing, scenario analysis, so we just push our thinking to get a deeper thought process in place to understand the dynamics and how it's going to impact the firms that are serving small businesses, smallholder farmers. On the right-hand side, you can see the work of one of my PhD students, Ben Collier, where he actually demonstrated with mixed market data and EM-DAT data that on average, the growth of the microfinance institution suffered 12% the first year, 10% the second, and even negative in the third. Think about what the extreme events would be if that's the average result. And it really begs the question of what happens to growth, as I've explained to you as well. And if you're not having that growth, appreciate you're not really helping smallholder farmers in that geography. So you can see I'm very concerned about what we don't know about extreme events and how they impact the growth. It shouldn't be difficult to understand why firms are reluctant to provide their services to farmers who are in high-risk regions, and also why they charge more for those services. Okay, let's go to the next slide. We'll crank it up and start explaining a few pieces that this really helps set the stage for what Chuck is going to present. This is a lot about not only how you do these things, but also what is the financial innovation that goes with it. And with Rockefeller Grant some years ago, we realized that you could put all of this into a single debt instrument, and the contingent debt piece could be subordinated debt, or I'm sorry, the risk transfer could be subordinated debt that would convert to capital. So you'll hear much more from Chuck about how to package this. I think this is an opportunity that we all need to take to heart, because it also gives us the proper way to enter into a country quickly without all the extra burden of trying to educate the insurance regulator. The insurance regulator will watch this, but this is a banking regulator story. So this is something to keep in mind as Chuck presents his story. If we go to the last slide, trying to bring to bear some of the things we've learned here. We all know that protecting farmers by passing the payments is something that is important, but those of us that have tried it know it's also expensive. We've got some good success stories here and there, but still, I guess I'm making a case here that protecting some portion of the firm's balance sheet can be quite a bit less costly, potentially more sustainable. And we have to ask the question, where's the largest value for money when we understand the dynamics that I just explained? If we go to the process of thinking about the impediments to scale with the Meso-Level, we still have a challenge, because it's still the geographically concentrated and small firms that need this protection the most, but yet it's difficult for that to be a commercial proposition for risk transfer providers. We've seen that with a network of firms, and you'll hear more from Wendy about this, you can start to pass the benefits, and you can change that dynamic of the scale. And you can make it more interesting for the commercial sector and for the firms that are protecting smallholder farmers. The other thing that was really fascinating for me was, as we were educating clients about the index and helping give them a real detailed analysis of the geographic spread they had and the types of events that were going to create problems for them, we saw their thought process and their practices changing. I saw that happening a lot with Vision Fund, that they were thinking, oh, well, we can do more reserving, we can provide our own contingent credit within our system. So there's a lot of risk education that takes place because you're doing these programs. And that's fundamentally important, in particular for the development community to understand and how to support that. Contingent credit has a significant value. You're going to hear Chuck talk about this. The nice thing about a call option on credit is it also eases the concern of the financial institution to have a full understanding of what their financial needs are going to be in the moment of the disaster. That's really important. The development community is beginning to realize they can play a larger role. I did a bit of work for ACLIF, and you can probably Google it and find the paper that was produced of how to scale these ideas up. So that's something that you might want to search for. The other thing that we're working toward is maybe we could build a global liquidity facility that uses a repo transaction, a repurchase transaction, to actually work through the central bank and shore up the liquidity position of all the financial institutions in the country. But we'll leave that one if you want to ask more questions. I think the main thing I want to say is thank you for your endurance, for my passion about this topic, and do appreciate that if you don't remember anything else, just come back to that growth slide and understand the impact of the growth of the firm when there is a disaster, and take that logic and transfer it into what happens to smallholder farmers. Thank you very much.
Thank you so much, Chuck. Over to you, Wendy, for the next session that will take us through global parametrics lesson experience and the lessons learned from that, and specifically focusing on Meso-Level index insurance for the solutions. Over to you, Wendy, please.
Thank you so much, Q. And good morning, good afternoon, good evening, wherever anyone is based. Thank you very much to Q and team for inviting me to speak today. And thank you to Jerry as well for giving such a holistic and comprehensive introduction, I think, to Meso-Level solutions and some of the lessons learned from decades of experience from implementing them globally. So thank you very much. As Q mentioned, I will be giving an introduction to global parametrics, some of the work that we have been doing as well, and focusing on two particular case studies where we've been implementing Meso-Level index-based insurances, one based in the Philippines and one based in East Africa. So next slide, please. So for those of you who don't know much about GP, Global Parametrics, we were founded in 2016 with seed investment from the UK and the German government. And we were founded with the intention to build the tools that were needed to develop and deploy parametric solutions globally. So we aim to drive what we call impact through innovation in parametric product design and in distribution. So we manage a fund as well. It's called the Natural Disaster Fund. It is a public-private partnership with seed investment from the UK government through FCDO, so through the Foreign Commonwealth and Development Office, and the German government, so via KfW. We have a partnership as well with global reinsurer Hannover Re, and these are the transactions are designed to back the solutions that we develop to be deployed in ODA eligible countries. As part of the NDF, we also manage a technical assistance facility, and this is a pot of TA which has been created to pilot and scale innovative and impact-driven NDF transactions. And that is the pool of TA which I manage, and I'll be discussing two case studies which are key TA and NDF programs when we go into the case studies later on. So if you go into the next slide. Thank you. In 2022, the NDF was deployed in 16 transactions across 55 geographies, across a number of different sectors, including agriculture, business continuity, and the public sector. So when we deploy the NDF, we look to design transactions which are enabling scale. And the way that we measure these impacts are by the increase in risk transfer, the number of policies sold by partner, geographies, perils covered, looking specifically at replication as well, but also ensuring continuity of transactions. And so we really look to ensure that sustainability is at the heart of the transactions that we design. And so looking into ensuring that we get renewals, ensuring that we get private capital crowded in alongside the transactions that we have, and ultimately that we are addressing the most vulnerable. So looking at beneficiaries being directly and indirectly covered by risk transfer. And in 2022, we actually managed to cover over 23 million beneficiaries within our portfolio of transactions. And so operationally, for the programs that we have deployed, if you go into the next slide, I wanted to lay out some of the key factors that we look at in terms of meeting those three key targets. So first and foremost, and I think you saw that in Jerry's slides initially, we're looking at being able to understand, own, and effectively manage risk. What we need to do on the ground is ensure that we have accurate risk assessment. And this can come from the data sources that we are looking at, but also ensuring that we are aligning with partners in terms of the data they are able to provide to ensure that we're looking at key perils that actually accurately cover the risks that we are looking to cover. Operationally, we're also looking at ensuring there is an enabling environment, both from the regulatory perspective, but also from policy, from public ownership, from government buy-in as well, to ensure the sustainability and the longevity of transactions. Understanding throughout the value chain is also critical. And this is key to get buy-in from each of the actors within the value chain to ensure that the coverage objective of the product that we are designing is understood by all key actors within the transaction. They're also understanding data accuracy and the limitations of the data that might have access to, alongside conditions of policy as well. And this kind of leads on to our point around stakeholder alignment. So ensuring that both short and long-term strategic objectives are aligned for long-term growth. And finally, focusing on holistic risk management. So taking into account services that fall outside risk transfer, particularly related to risk mitigation and adaptation to ensure the longevity of transactions. So if you go on to the next slide, the first transaction I want to talk about, the first case study, is a program in the Philippines. We are working with a carrier called Climes, General and Life Insurer. And this program began in 2021. Some context for the Philippines, but I'm sure many of you are aware that flooding, tropical cyclone, drought, and many other extreme weather events regularly cause losses and damage to the agricultural and food value chains. And when these events impact harvests, farmers can often lose income and struggle to pay back loans. And so the solution we developed with our partners, Climes, was to develop a parametric protection covering both excessive rain and tropical cyclone wind speed events to be distributed by Climes to agricultural lending cooperatives. So the partners we work with on this particular transaction are Climes. We work with them and provide reinsurance as part of the NDF partnership. And we developed the program as Global Parametrics alongside our partners, Ibiza Network. Ibiza provides, alongside product development services, a policy monitoring platform which allows both clients and the cooperatives, who are the ultimate policy holders, to be able to view the data and to be able to view their policy, which provides a nice educational tool alongside a way to basically administer the policies on the ground. And to link back to the point that I made around focusing on holistic risk management, we also engage the services of the Sept Biodiversity Alliance, who provide agro-advisory services to the cooperatives alongside the risk transfer. So to give you a little bit of and more detail on the components of the cover, the protection is offered on an annual basis through Climes to cooperatives, and it protects the loan portfolio of the cooperatives against excessive rainfall and wind speed perils. We subdivide the protection between index parameters per province and per peril in order to distribute the policies accurately. Payouts are also structured across 3 separate triggers. We did this to ensure simplicity of the design of the product, whilst also trying to triage the risk for different severities of events. And as I say, reinsurance protection is provided to clients via the NDF partnership. So in the diagram here, you'll see that the NDF partnership provides the reinsurance via clients down to the cooperatives, and the Ibiza platform provides that policy monitoring, which allows visibility of the policy alongside the parametric data. If you go on to the next slide, I can give you some updates in terms of the impact of the program. And so we began the coverage in 2021 with a target of 5 cooperatives. Initially, 14 cooperatives registered, as the Protect Insurance was very popular. And this was in 41 provinces covering excessive rainfall perils. In our first year, we also managed to see some payouts across a number of events for these different geographies, and we mobilized $1 million in capital. For the next year, this was scaled up to over 100 cooperatives, and for the majority of the provinces within the Philippines. We also added in at the request of the cooperatives the tropical cyclone wind speed peril, as it was seen to be causing more losses than just excessive rainfall. And drought cover is also in development for year 3. For year 2, we have also seen payouts for a number of events. We've managed to mobilize quadruple the amount of capital than year 1. So first of all, focusing on that holistic approach, which I outlined in the key factors for sustainable growth. So clients wanted to take the view that they were not just offering a risk transfer, they were also offering learnings to the cooperatives on the ground to be able to allow the cooperatives to understand and effectively manage their risk. So this takes the form of understanding the risk transfer component, and that's been very, very helpful from the monitoring tool to be able to map the data accurately for the cooperatives to be able to see how it tracks alongside their experience on the ground, but also thinking about the advisory services that are offered throughout the policy period from the Sept Biodiversity Alliance. So thinking for the events that are not as severe to trigger the parametric policy, the smart advisory to be able to pass the information down to the smallholder farmers in a way that allows them to adapt to the patterns of severe weather. The impact of cover on behavioural change of the cooperatives is currently being evaluated. So we have engaged services of academics from the Wharton School and the University of Chicago in order to try and map this and to see if there has been behavioural change as a result of the policies that have been sold. We've also seen from some of the evaluations that have been conducted by clients on the ground that the use of the monitoring platform has been very helpful as an additional education tool to be able to explain the product and explain how it accurately maps to people's lived experience on the ground. However, in terms of lessons learned, basis risk is still a key challenge for cooperatives who have not purchased parametric policies before. Looking at data sources that they don't have much experience with, and engaging with clients on how parametric policies can work on the ground. There has been some issues with basis risk to accurately manage expectations. And so that's something that we'll be monitoring moving forward into year 3 in order to see if we can move the different trigger levels and see if we can adapt to some of the challenges that have been posed in year 1 and 2. So moving on to the second case study. Next slide, thanks. This is working with a social enterprise called 1 Acre Fund. They provide smallholder farmers in 9 countries across Africa with financing and agricultural inputs to combat poverty and hunger. And so we've been working with 1 Acre Fund since 2019 on a mesoscale cover to protect their portfolio of farmers against key perils. And protection is offered on an annual basis to 1 Acre Fund, designed to protect key agricultural economic zones against droughts and excessive rainfall perils. So we map the protection to our crop phenology in the key areas that 1 Acre Fund is piloting this kind of cover. Payouts are distributed directly to 1 Acre Fund, who distributes the benefits down to smallholder farmers, depending on the need of the farmer on the ground and their own internal assessment. And so this can be done as loan forgiveness, this can be done as purchasing agricultural inputs, or this can be done as direct payouts. And this all falls into the idea of Meso-Level cover, so allowing the risk aggregator to be able to understand and effectively map how best to distribute the benefits down to their beneficiaries following an event. And again, risk transfer is provided to 1 Acre Fund via the Natural Disaster Fund partnership. And so in this particular case study, the Natural Disaster Fund partnership provides the risk capacity to 1 Acre Fund, who passes the benefits down to smallholder farmers within the agricultural economic zones. We provide the index as Global Parametrics and the calculation agency services as well. So on to the next slide. For year 1 and 2, we have been piloting the cover in Tanzania for drought and excessive rainfall perils, so indirectly covering over 70,000 farmers with our risk capacity. And for year 3 last year, we sought to scale up the risk transfer into both Malawi and Rwanda for pilot transactions, so covering over 4.5 million farmers indirectly. But this particular year as well, we have received payouts following a drought trigger in Tanzania and following Hurricane Freddy in Malawi for excessive rainfall. And this actually, the Hurricane Freddy case study was a very interesting one for One Acre Fund, as they were able to use their capacity on the ground to accurately understand how the event had implicated the farmers within the agricultural economic zone, and able to understand exactly how best to distribute the payout internally to those farmers. And so in terms of the current lessons learned, at the high level, allowing the aggregator to cover the beneficiary in an appropriate context in whichever manner makes most sense. But at the same time, the meso-scale protection limits the needs for distributing costs and the challenges for policy education and for uptake. However, obviously, cover cannot be used as a perfect substitution for shocks to yield at the household level as it's coming in at the aggregation level. So I will close up there. I know there's some questions here, but I will answer those within the QA. And so thank you very much again to Q and team for having me, and looking forward to answering questions following Chuck's presentation. Thanks very much.
Thank you so much, Wendy. Super interesting, relevant applications. And I think very nicely demonstrates the 2 cases where it's a financial institution and another within a firm or organization that's serving farmers in some way. So very illustrative examples. Up next is Chuck, who will share more from his experience with enabling capital and a specific microfinance fund. Over to you, Chuck.
Thank you, Q. Appreciate actually the way that Jerry, Q, and Wendy have set the stage for me. I think I don't have to go into as much detail on some of the aspects of the product, given the stage has been set so well. However, I would like to point out that the perspective of my presentation is slightly different than those of Jerry and Wendy, because they're actually climate risk or parametric risk sellers. And I'm actually a parametric insurance or risk purchaser. And I've used this purchase to create a new product that we call CRED, or the Climate Resilient Enhanced Debt product. But before I go into details of the product itself, I'm going to talk to you a little bit about enabling capital. So if you could go on to the next slide. Thank you. So Enabling Capital is actually a fairly young company. We actually incorporated the company in January of 2020, right smack in front of the COVID crisis, which left us a little nervous, of course, as we were starting up a new company with one fund, which at the time was around 60 million in assets. It was the EMF Microfinance Fund. And we had a lot of ideas in terms of how we wanted to manage the company. We wanted to be open and innovative, and also make sure that we had incorporated key aspects of good corporate governance so that we could continue to be innovative. Fast forward to today, enabling capital, or EQ as we call ourselves. We are now managing 2 funds, the EMF Microfinance Fund, in addition to this, the Spark Plus Fund for Africa, which focuses on clean cooking. And we are currently advising on over 650 million in assets, in US dollars assets. And we have grown from four founding partners to a company of more than 50, spread across 5 different continents. And we're managing, we have investments in more than 45 countries, and investment and relationships with more than 130 institutions, both clean cooking and financial institutions. You can move on to the next slide. So I've known Jerry for a long time, and we've been thinking about the impact of disaster. He's been thinking about it a lot longer than I have, but we've been debating and discussing the impact of climate events on financial institutions and their borrowers for a long time. Next, please. The next, whatever. Okay. I've actually reversed my slide. I'm starting with a financial institution because that's the client, the primary client of the EMF microfinance fund. And what we have seen over time is that climate events do have an impact on financial institutions. What we see is growth starts to slow. If not, the institution actually can shrink depending on the severity of the climate event. Non-performing loans increase in the financial institution because the borrowers have been impacted by the climate event. The balance sheet of the financial institution is weakened, as Jerry showed in his slides. And what that means is that lenders like the EMF Microfinance Fund start to look at these financial institutions a little more carefully, and many of them stop lending to them so that it has a severe impact or can have a negative impact on the liquidity of the financial institution. Next, please. And this, of course, has ramifications on the borrowers themselves. The borrowers, of course, lose time rebuilding their businesses and actually negotiating with the financial institutions, which is also a significant loss of time. There's no new credit. So the financial institution itself has been impacted. Therefore, it cannot continue to lend to the clients, even if it wanted to. But in most cases, financial institutions, as Jerry pointed out, start to restrict credit after a climate event. The standard of living of the client is reduced, and in some cases they have to sell assets into a marketplace that's not very conducive for receiving a fair price. And in extreme cases, they have to migrate to another town, another region, or even another country in order to support their family. Next slide, please. So as we been thinking about this, about the situation in, about the varying needs that the financial institutions and their borrowers have, I like to always reflect on and try to sort of personalize the situation to people, because I think that's when we understand it a bit better. And so in the event that there was a storm in your community near your home, and this storm, maybe it was a mild windstorm and it knocked your shutter loose on your window, you wouldn't need to take out a loan. You would just simply observe what's happened, go down to your hardware store, buy a screw, maybe a little paint, and fix the shutter yourself. And you can do that all probably with the cash that's in your wallet without having to stretch your into even your savings account. Next, please. However, as the severity of the storm increases, and perhaps the roof of your house gets blown off, then you're going to need more cash than what you can finance from your own wallet. Hopefully you have insurance, but as we all know, insurance adjusters take time. They take time to visit you. They take time to sort of agree on how much you're going to be compensated. They take, and then it takes time to process the check and get the money back to you. And in the meantime, you're set without a roof. So what do? You have to either draw into your savings if you have, or you take a loan if you can get it. And that's the way a lot of people resolve this type of situation. However, and next, please, if the severity of the storm is even greater and your home is destroyed, most of us can't afford to dig into our savings to rebuild our home. Most banks won't lend to you because you no longer have a home against which you can guarantee the repayment of the loan, which requires a different type of financing. Hopefully you have insurance. Hopefully you have access to soft capital, but it's clear that a different source of financing is needed. And this analogy is paralleled within the financial sector as well. We can go on to the next slide, please. And so as we were thinking about the development of the CRED product, the Climate Resilient Enhanced Debt product, we were thinking about how we could blend two products. Next, please. So on the one hand, a senior or subordinated loan, so a typical credit product, perhaps packaged as a credit line. Next, please. Along with a parametric insurance product. What I like to call as a climate hedge, because then I can frame it as if it were similar to something that people are more familiar with, such as a foreign exchange hedge. And we combine these two products, or we fuse them together, next please, to create the CRED, which is the Climate Resilient Enhanced Debt product. Next, please. And the next two slides, I'm going to go into a little bit of detail about how the product is actually layered. This is a very important concept and a key benefit for this product. So next, please. Within this trend, this CRED product, there are three players. Next. So two more nexts. There's the Enabling Microfinance Fund, which is advised by Enabling Capital. There's the Risk Transfer Hedge, or the Climate Hedge, which was provided. I'm going to specifically refer to a transaction that we did in Cambodia, where the Natural Disaster Fund, managed by Global Parametrics, they put the Climate Hedge in place. And then, of course, the financial institution, which receives the benefit of the CRED product. Next, please. So we started with Global Parametrics and developing the index. In the case of Cambodia, we were focused on flooding and drought. And so we worked with Global Parametrics to design an index that would trigger based on flooding and drought in Cambodia. This index was mapped out with triggers, which had a corresponding payout depending on the severity of the event. And of course, the Enabling Microfinance Fund had to pay for that, which we did via a product fee for this climate hedge. Next, please. Enabling Microfinance Fund then took this climate hedge, fused it with the debt product, and we ended up offering two products to the financial institution. In the first instance, we extended a loan, a senior debt, which I call BAU, business as usual, which was our typical senior loan. The second product that we offered was the CRED, which was a contingent credit line that had triggers that would allow the financial institution to convert part or all of that contingent credit line into subordinated debt, thereby creating tier 2 equity within the financial institution. And at the same time, remember that we had this climate hedge, which has a payout that's triggered by the severity of the events. We use the payout of that contract to forgive interest and debt and principal on this loan that was awarded. And the financial institution had the obligation, of course, to service the debt, so pay back the loan. And they also had to pay a contingent credit fee for the credit line that they had with the EMF Microfinance Fund. And we passed that fee on to Global Parametrics to cover the cost of the climate hedge, 100%. In fact, we subsidized the first year. We took part of the upfront fee for the loan and covered the cost in order to sort of encourage the institution to take up the product. And then in turn, next please, the financial institution had the obligation to put in place a recovery-based lending program, whereby they would take the liquidity that we provided and on-lend it to their clients. So that these businesses can get back up on their feet and operating. Next, please. So if that wasn't enough detail, I'm going to go into even more detail on this slide. But I think it's important because what I've found in the past when I've been trying to explain this product is that people sometimes get lost in these diagrams with lots of arrows. So I'm going to here in this slide lay out the four layers of credit. Of the 4 layers of the product. So the first layer that I explained was a senior loan, business as usual, The size of the loan is $1 to $5 million. That's our typical loan. The average loan size for EMF is $1.7 million, but we have some loans as large as 10. And the cost of this type of loan, of course, is risk dependent, and the risk of the underlying institution. In this case, I'm choosing 8% because that seems to be more or less where the market is these days, plus a 1% upfront fee and a tenor of 2 to 5 years. So this is the first loan, and the benefit of this to the financial institution is that they have liquidity to grow their loan portfolio. Next, please. And then once a climate event happens and the trigger that they have in order to draw on the credit line happens, then the institution has the ability to draw a loan between $1 to $5 million. And this next point is extremely important, right? So we fix the interest rate and the tenor so that it mirrors the first transaction. And why is this important? This is important because the risk of this institution has increased. And by fixing this price and the structure, we are basically not taking into consideration the increasing risk from the financial institution. The benefit that the financial institution has is they have certainty of liquidity as well as price during the climate event. Next, please. In addition to this liquidity that we provided in this second layer, the institution also has the option to convert all or part of that credit line into tier 2 capital. And their ability to convert is based on the severity of the event. As the severity increases, their ability to convert more of the senior loan into tier 2 equity or sub-debt increases. The cost, we also fix that ex ante at the point in time when we sign the contract for credit, and we typically price sub-debt at anywhere between 200 to 300 basis points higher than our typical senior loan that we do. The benefit to the financial institution of this is that they have timely tier 2 capital when they need it, and they need it because the severity of the event has jeopardized their capital, and by converting this loan into tier 2 equity, they're able to sort of plug that gap that's been created from the climate event. Next, please. The last layer, which is also a very important dimension of this structure, is the tier 1 capital. And so it's in this layer where we forgive part of the interest and principal of the loan from the contingent credit line that we've given, based on the payouts that we've received from Global Parametrics in this case for this transaction. And the benefit of this transaction is that they get tier 1 capital when they need it. Next, please. So now you may be asking yourself, what makes CRED so special? So one of the key things that makes, so next please, what makes this special is that this product is tailored to the needs of the financial institution, both on the climate hedge side as well as the credit side. And why is this important? It's important because the needs, the climate perils that these institutions face are different in different markets. For example, in Latin America, especially Central America and the Andean countries, earthquake is a significant event. There was a lot of interest from our borrowers in these markets to look at climate hedge that focused on earthquake risk. Obviously, for the Philippines, it's cyclone risk or flooding, and that's the type of peril hedge that they would be looking for there. And we're able to modify this peril depending on the market and to the needs of the institution. The same on the credit side. So for smaller institutions, we can shrink the size of the loan so that they can absorb that amount of credit, or structure it differently, because that's kind of what we do and what we enjoy on the credit side. Next, please. I think I've beat to death the concept of financial layering, but I've added it here because I do think it's an important dimension. Having an institution get liquidity and capital when needed, based on the severity of the event is actually quite an innovative product, I think. Next, please. Okay, that's so fine. That's fine. With the structure, I think is actually was very intentionally done, and you'll notice that when I'm speaking from EMF's point of view towards the financial institution, the language that I use is always couched in the term of banking terms. So we have a contingent credit line, something that banks and bank regulators understand. We convert the senior loan into subordinated debt, something also that's practiced and widely observed. And we have debt forgiveness, which creates tier 1 capital. All three of those things are easily recognized and understandable by both the financial institutions as well as the regulators that might be regulating them. All of the intricacies and the complexity of the parametric insurance is housed within EMF, so that we don't have to get involved with the insurance regulators, where parametric insurance may be a new or novel product, and so by avoid this type of discussion. Also, in addition to, I think, which is important, and I've alluded to it in a couple of the other slides, but it's objective. There's no subjectivity around the liquidity. Once the trigger is breached, the financial institution can call the liquidity, and there's no claims adjuster that's going to come to the institution and decide, how much they're entitled to. Next, please. And I've touched on this next point on several times, but I think it's important to emphasize it here. The borrower, the financial institution, has no obligation to draw on the contingent credit line, nor to convert it to sub-debt. These are at the option of the institution. This is part of the key to this product. It resolves the uncertainty and helps them with what Jerry has framed as the business continuity, and so that they can continue to operate, both with liquidity as well as with the requisite capital. And the last point, so next please, little quick. We structured CRED within a commercial fund. So there's no DFI money embedded in this. The only subsidy that's been in there was the subsidy from the fund itself towards the borrower. So we have an existing pool of capital in the EMF microfinance fund, and the mandate of CRED fits well inside the mandate of the fund. And so we've tried to date to do this commercially, and to some degree of success have been able to do so. Maybe next, please. The next slide. Lessons learned. Okay. One thing that I'm sure you're all aware of is that parametric insurance is complex. Neither Jerry nor Wendy actually touched on this, but everything that goes into creating these indexes it uses a lot of data, a lot of math, and it's very difficult to explain this. And for us, what was really important, and we learned this sort of halfway through the Cambodia structure, was that we needed consistent and clear reporting towards the financial institution. This helped us to build trust with the financial institution and make sure that they both understood where they were in the index, as well as starting to trust both global parametrics and enabling capital more. And we also spent a significant amount of time trying to simplify our marketing around the product. My initial marketing presentation was way too complex, both for internal purposes as well as external purposes, and we had to significantly simplify the marketing around that. Next, please. The cost matters, absolutely matters. In my dealings with microfinance institutions, I've lost just simple plain vanilla transactions for 10 basis points. They walk away saying that I'm too expensive. Imagine what they were saying when I told them that they had to pay an additional $15,000 to $20,000 for the climate hedge. Okay, so we did lose transactions, after spending a significant amount of time explaining to them the benefits, etc. By the time this transaction made it up to the board, they said it was too expensive and they didn't see that they didn't want to engage in the transaction. But cost also matters not only at the financial institution side, but also at Global Parametrics and EQ as well. I think both Global Parametrics and EQ have invested a lot of time and energy and actually even money into this product with the belief that we would be able to gain scale. We're not there yet, but hopefully we will, but cost does matter at all levels. Next, please. And I kind of alluded to this already. It's critical to have an internal champion, someone who can explain the product, preferably somebody at management level or perhaps within the board as well, but they need to be able to push the product through. Next, please. So regulation and controls matter. Yes, we can convert the tier 2 by merely flipping the switch. However, since the advent of Basel II, regulators in almost all jurisdictions need to approve any tier 2 documentation. So there was one transaction where I think if we had been better able to explain why the delays of this approval didn't matter, we probably could have closed it in Bolivia, because there the approval process for sub-debt is extremely long, and there was concerns by that institution that it would take too long. In other markets, when I say controls, there are foreign direct investment controls. Any cash coming into the country needs to be approved by the central bank, and that limits or slows sort of the immediacy of getting cash into the financial institution when they need it. Next, please. The next point is sort of my basic credit perspective, but one that's quite important to me. For recovery-based lending to be effective, the initial underwriting has to be done well. Otherwise, what happens is you're building a house on a swamp, and you run the risk of over-indebting clients rather than helping them improve. So this is a critical point that's really just basic credit, but it's actually a very important point, and one that we emphasized a lot in the development and rollout of our product. Next, please. Technical assistance can help. In fact, it helped a lot in the case of Cambodia, because what we did was help the institution develop their recovery-based lending product, and in the end, they actually used the whole process and concept when the flood hit. So we found that it was, and we also learned quite a bit with these focus groups and better understanding the needs of the end clients. Next, please. This next one is something that always sits poorly with me, because the first time I tried to get this product, the CRED product, approved by our custodian bank, the email that I got back was, "This sounds like you're sending good money after bad," because basically it didn't make sense to them why we were lending to an institution that had just been hit by a climate event. I then had to go back and explain to them again the logic behind recovery-based lending, and there is a strong logic behind it. Most of the small farmers and small businesses that are hit by a climate event aren't looking for a handout. They need capital. They need capital to get their businesses back on their feet. And the minute that this financial institution provides that capital, it allows them to get their business started, and for the financial institution, it really develops significant client loyalty. Imagine if you're sitting there after your business has just been destroyed, and the financial institution is willing to give you money to get your business back on its feet. You're going to be willing to work with that institution for a long time to come, and that is a very important and relevant point. Next, please. This next one came out of, and actually was triggered by something that Q and Astu said in our preliminary conversations. We went into this transaction thinking, okay, we need to be quick. We need to be able to respond. We need to get that cash out there. They need to be able to put the cash in the hands of these micro entrepreneurs or the small businesses so they can get their businesses up and running. When we did the focus groups, they said, nah, we don't really need the cash right away. We need the water to recede first, and then we'll think about whether or not we need additional cash. What we need in the first instance is restructuring. We don't need money. We don't need to be over indebted and have cash sitting there that we have to pay interest on. And so these are things that, and my second point to that is that the documentation has to follow. When we structured the documentation on CRED for Cambodia, we had a very short window of opportunity for the institution to draw on the line of credit. Hindsight forced us to relook at that and make sure that the window that they had to draw the line was sufficient in order for them to take advantage of it. And the last point, and is something that I saw on Wendy's slide, and I heard Jerry touch on it, but is that basis risk does exist. And one of the beauties of this product is that we were able to reduce some of the basis risk. If you go to the next slide, please. And so this is the part of the reporting that we provided to the financial institution in Cambodia. And the blue line at the bottom of the slide with the red dots is where the red dots are the peaks of the flood. And you notice that on October 5th, that blue line got almost up to the yellow dotted line, which was the first trigger. And that was the first trigger where the institution could come knock on my door and say, hey, you know, I need that loan. I just triggered this. And so when we saw this, we of course sent the report, and we called up the institution and said, look, you didn't breach that trigger, but in order to sort of, because of the proximity that you have to that trigger, you know, even though we don't have a legal obligation to extend credit to you, we will do so anyway, because you know, we spent the time to build out the products. We're sure that you have the processes in place, and we're willing to take this risk, even though there's no legal obligation to do so. So this was one way that we could reduce the amount of basis risk in the product. Next, please. Okay, last slide, I promise. I'm kind of like Jerry in this. Once I start talking about it, I really believe in it, and I start to talk probably too much about it. So here's the challenges and opportunities. You heard both Wendy and Jerry talk about sort of the benefits of you know, the Vision Fund contract, where they were across several markets, et cetera. You know, right now, the way we've engineered the process, we go out to the institutions we think that CRED will be interesting to, and start to market it to them. And then once we have interest, then we work with Global Parametrics to try to put a cover in place. Well, that hasn't worked because we haven't got to scale. And so thinking about it, this is, of course, not necessarily a commercial response, because we would need some kind of support to do this, but we believe that by establishing a portfolio level cover for the EMF fund first, and then going out to the institutions and say, look, guys, we got this set up. You know, are you interested in participating? And this is what it's going to cost. This might be a more attractive option, and might sort of grease the wheels to getting scale around this structure. Next, please. The other challenge that we have is that, you know, even though we've launched this from a commercial fund, we had no liquidity backstop specifically for CRED. And so what I had to do was hold cash collateral against every exposure, because the credit line that we had in place was specifically to meet redemptions in the fund for investors. And so a particular challenge for us, and we went out to several DFIs to see if they were interested, and everybody said no, that's too much risk. You know, it wasn't something that we were able to do. I think if we're going to get scale on this, we would absolutely need some kind of a liquidity backstop for this structure. And last, next please. The last point is that I think the TA facility that we had implemented in Cambodia really showed to me the necessity of having a facility where we can help the institutions build a recovery-based lending product. COVID actually helped because a lot of financial institutions utilize a recovery-based lending approach. So the concept is there. It's just not necessarily being applied in the context of climate events. So having a TA facility to help the financial institutions develop these products would also be quite essential for us to further scale up the product. So that's it for me. Thanks, and I'll put myself on mute while we go on to the next section.
Thank you so much, Chuck. Again, very, very practical, tangible, illustrative experiences, really benefited from that. So we're heading over to an open discussion session, question and answers. Thank you for those that have already started popping questions onto the chat. So right away, we'll pick some in this first round of questions and address those. We'll have a follow-up round of questions after this. Perhaps to Jerry, first to you. There is a question on crop insurance products. So it says, we have seen a lot of crop insurance products for inputs, but inputs represents a tiny cost of the overall cost of production for smallholder farmers for most crops. Can you talk about products and services for more important factors of production for smallholder farmers like land and labor?
Well, let me say something about
Wendy?
input. Oh, sorry.
Shall I quickly give a question to each of the panelists, then we'll open it up, sorry. To Wendy, there's a question around payment of premium. So it says, who pays the premium? Financial intermediary or end client or a donor? Do end clients get a choice of accepting or rejecting such an offer, or does it become a mandatory cost for them? And in the later case that it becomes mandatory for them, would this not increase the effective rate of interest and potentially trigger issues with interest rate cap regulations? To Chuck, there's a question specifically on CRED. Do you lend CRED to small agricultural banks or financial cooperatives? What is the least credit rating that a financial institution could have for it to access CRED? I'll stop there for now. We'll take another round. So Jerry, over to you.
Okay, well, on the input side, I think that's really an important play, because if you think about cropping, it's a year-to-year thing. Hopefully you don't have multi-year drought. So there is a chance to recover. So the idea, I think, is properly focused to be looking at actually helping farmers start again with the input side of the story. If we start going into hard assets like land, it's really difficult for me to envision any program that would actually hedge against the fluctuations that may occur in land pricing because you live in a risky area. I think you have to think through these protections and how they're going to provide more opportunity for providing more services in the area. So that would also protect land. But purchasing land is a whole different area of need and financial need. So I'm not exactly sure what's involved there with that question. On labor, sure, you can work with labor groups in order to protect the business interruption that will occur for them if there's not a crop to be harvested, if there's bad conditions. So, very receptive to those types of ideas. Hope I touched on most of it.
Is it my turn? I'll just jump in. So yeah, no, it's a good question around who finances the premium. I think that's the first question anyone asks anyone when you put together a parametric risk transfer. And it really depends on the nature of, first, the risk aggregator you're working with, and secondly, the coverage objective that you have for the solution you're looking to implement. So to kind of call back to the two case studies that I gave, the first one with the Climbs Weather Protect insurance, that was distributed as an insurance from Climbs to the cooperatives. And so the premium was paid by the cooperatives themselves. Secondly, the case study with One Acre Fund. One Acre Fund are a NGO inherently, and so paid for the premium themselves, but were a recipient of donor funds from a third party for the Rwanda pilot for this year. And that was particularly helpful to provide premium support in order to move the triggers to somewhere that essentially was within the range they were looking for. But as I say, generally, it does depend on which actor you're working with and what you're looking to cover. So if you're looking to cover, for example, business interruption of a firm, then they would be covering that themselves if you're looking to sort of pass down the benefits from that. Again, I hope that answers your question. I'm happy to take follow-up.
And now my question on, can we lend to small agricultural banks or financial cooperatives? It's funny, I almost thought that this question was put there by my marketing department, because the Enabling Microfinance Fund, actually, one of the ways we differentiate ourselves is that we target sort of what we call our sweet spot, in our mid-sized financial institutions. We don't typically go after the larger banks, because they generally, the risk-adjusted pricing that we get from them isn't so attractive. We tend to work more with sort of the mid-sized to smaller financial institutions in the markets. So absolutely in scope. The only thing that is important, and I emphasize this in terms of the underwriting, any institution that we work with has to have good underwriting in the first instance, because otherwise what we're doing is we're harming vulnerable people even more with institutions that may have the best intentions in place, but not necessarily the best underwriting. And so there we're very careful, because we don't want to do further damage. So whatever the institutions that we work with, the underwriting, if it's good, we are more than open and interested in working with these smaller institutions, as even agriculturally focused institutions. So absolutely in scope.
Thank you so much, panelists. I'm not sure if there are any further reflections on some of the questions that were not directly targeted at you from either of the panelists to this last round.
Well, there are a lot of good questions here. I think I'm really happy with the way Wendy and Chuck came through with their presentations, obviously, reinforcing so much of what we're trying to move toward. There's a lot of work to be done, and this community is going to be an important part of that. So thank you for the opportunity.
Thank you so much. I know we're right on time, but I just have one question, which I think is very directly targeted at Chuck. It's a question on the fact that your cost matters, your reflection and the lessons learned. Question is, do you see sufficient financial impact from natural disasters on financial firms or intermediaries that they would purchase insurance against these perils? So it's a question of demand.
You're a really good question, huh? It's one that Jerry and I have been debating, and this is part of the reason why I think the answer to the question is yes. We have seen enough climate events that have affected the balance sheets and income statements of financial institutions. This is categorically yes. However, it's just like when you're selling insurance. It's only relevant when you're in the painful process, right? You're not having car insurance and getting in a car accident, and you're kicking yourself for the next 2-3 years, and you put car insurance in place. I think the same holds true with what we're trying to do with CRED. Most of the financial institutions that we've spoken with, they say, yeah, okay, that's important, and we do see a deterioration in the portfolio, but we get through it every year. But they don't really step back and look at the impact on liquidity, growth, capital levels, and quantify it. And this is actually really important. And I didn't continue my thought around the Cambodia when we went back and we offered them this credit line when there was this basis risk. They turned us down. 3 months later, they came back to us and said, well, our portfolio quality has deteriorated. This lender decided not to lend to us. Can you lend to us now? And so it would play out exactly like I had told them in the presentations, that there's always a delay. Your portfolio quality will delay. You will lose access to liquidity, and sure enough, it happened. we ended up lending to them. We lended to them about 4 months after the crisis, because we saw what they did. We knew that they had the structure in place, and we worked with them because we wanted to show that we believed in the product and we believed in the institution. So, but you know, they after all of the work that we did, didn't, I think, completely get the ramifications and the implications of these climate events on their balance sheets. And the liquidity and the impact on liquidity and capital, et cetera. So, yeah, I mean, yeah, I'll stop there. And I'm sure Jerry has something to add, because this is something we've talked about at length in the past. So,
opportunity cost is easy to teach, but it's really difficult to put in practice. It's just the bane of economics, that decision makers understand opportunity cost, but they don't take action to deal with it.
Thank you so much, Jerry, and the entire panelists. I couldn't have ended it at a better note. And I think that slide, Jerry, that you mentioned as the key takeaway is probably a good answer also to this question, right? It's not just the immediate impact, but 5-6 years on, what is the quality of the business and its ability to continue growing. So with that, on that note, I would like to bring the webinar to a close. A big thank you to Chuck, Jerry, Wendy. Fantastic presentations. Reminder to panelists, please look out for the fact sheet. We will be circulating it out shortly after this, together with the recording and the PowerPoint presentation. And please look out for our 4th webinar coming up in October on the impact of the latest technology on climate finance. Thank you so much, wherever you are. Enjoy the rest of your day. Goodbye.
thank you.
Thanks, everyone. Bye.